Hello and welcome to another episode of the Mark Moss Show, where we talk about Bitcoin. We talk about the decentralized revolution that is happening in the world right now, cryptocurrency space, of course, looking at through the lens of politics, finance, and technology as it reshapes the world that we live in. Now, each week I try to bring to you some education to change the way you think about this so you can see it with more clarity, because I know things are scary, things are dangerous, and if you don't look at them the right way, you could get faked out, you could miss out on this opportunity. Of course, I try to bring to you some of the latest breaking news and, of course, some interesting guests. So you don't have to listen to me all the time. But right now, we are going to dip into some education so you can understand exactly what is going on, because it is I'm just going to use the word. It's a bloodbath. It's a bloodbath. I say it's a bloodbath because the markets are a sea of red. As a matter of fact, a couple days ago, the entire S&P 500 stock market index was completely red. Now, that's not something you see. You don't see the whole thing turning red, but that's exactly what happened. And that's why, like I said, it is a bloodbath. And it's not just stocks. We got the S&P 500 down. We got NASDAQ down. And of course, the entire Bitcoin and cryptocurrency space is getting crushed as well. And so that's why we're talking about it as a bloodbath. Now, I've been talking about each and every week. If you have been tuned in, then you're already caught up. If you're not tuned in on a regular basis, then what are you even doing? Just take a second right now, grab your phone, pull it out if you're not driving. Set a calendar appointment for this time on this channel to join me each and every week, because you do not want to miss what we are talking about here. And if you have missed it, that's okay. Don't worry about it, because you can just go check it out on the Mark Moss podcast on the iHeart Radio. So if you missed any of these shows, just go back. We have them archived there for your listening pleasure, because I don't want you to miss out on this education. We're trying to build on top of this. So anyway, here we are, bloodbath. What the heck is going on? Of course, we're talking about the markets, and it's really being driven by Fed policy, the central banks, the Federal Reserve of the United States, but other central banks around the world. And, being a financial analyst here, we typically used to analyze financial metrics. We would look at things, but today it's all about politics, because that's what's driving things. And we're trying to guess what is in their head, what is their motivation, what are they going to do based on those types of things. And so we had the Federal Reserve, the central bank of the United States, the biggest central bank in the world, the most powerful central bank in the world. They were going to have a meeting this week, and were they going to raise rates or were they going to lower rates? And of course, they decided to raise rates. Well, nobody thought they were going to lower rates. It was how much would they actually raise them? And I don't want to go super deep into this because, like I said, I've been talking about each and every week. But basically, by raising the rates, they're draining liquidity out of the markets. What do I mean by that? So the banks don't print dollars. What they do is they increase liquidity by lowering rates, because money is created through debt. So when rates are low, you go borrow a bunch of money. When rates are high, you don't borrow it. And when you borrow a bunch of money, all that new money is created into the system. And so by raising rates, they drain that liquidity out. So that's what's happening. That's to catch you up real quick. But I want to talk about specifically in the Bitcoin and in the cryptocurrency markets specifically today, because that is where we have some serious drama going on. Now, I talked about, I think it was a couple of weeks ago, breaking down what happened with Terra Luna, the U.S. stablecoins, UST, and how it was backed with another token called Terra Luna token, and how they tried to have this algorithmically pegged so it always stay at $1, and how it failed. And I broke all that down. If you want to go catch up on it, like I said, go to the podcast network and listen to that. But what's happened is it's created contagion. What does that mean? Well, you understand, like, being contagious, right? If you get sick, being next to someone else who's sick. Of course, you know all about that. We've gone through 2 years of a pandemic. Of course, you know about contagion. And so we also see that inside the financial markets. Now, the first time that I really saw this for the first time, where I really, really remember, was in 2008. And we saw the great financial crash, or the global financial crash, however you want to call it. I'm not sure which one is right. The GFC, they call it. And what we saw is the global financial markets all melted down because because of contagion. They were all contagious next to each other because they all had exposure next to each other. And so this bank had debt with this bank, and that bank had debt with that bank, and that bank had debt with that bank. And so when one went down, it was like a domino effect. And that's sort of what we're seeing today. And we knew that it was going to come because after 2008, supposedly the bankers and the regulators that are going to save us from the problems they create for us went and passed a bunch of new regulations to prevent something like this from happening again, which sounds like a good idea, which is exactly what they should do. Now, I grew up, my dad always told me over and over and over, hey, look, once is an accident, twice is stupid, right? You've heard like, fool me once, shame on me, fool me twice, or no, fool me once, shame on you, fool me twice, shame on me, right? So it's like, hey, look, mistakes are made. But the best we can do is learn from those mistakes so we don't make those same mistakes again. However, supposedly after 2008, they went to pass a bunch of new regulations to prevent that from happening again. But as a matter of fact, all it did was make things worse. And so now we have even more centralization through the banking system, through the financial system. And so we always knew that the next one was going to be even worse than the last one. And we're seeing it throughout the financial system, throughout Wall Street, but also through the cryptocurrency markets, which bring me back to the point that I'm making. And so back to a couple of weeks ago, we're here talking about US Terra Luna, the token, the stablecoin, and how when it crashed, it took out $60 billion. That's B with a B, a billion with a B, $60 billion worth of liquidity out of the markets. Now, it was devastating. I don't know how many people, hundreds of thousands of people, potentially millions of people lost a lot, potentially lost it all. I was in Vegas last weekend at the biggest crypto conference in the world at Consensus, and I was at their official after party, whatever. I was at some party, and someone walked up to me and he's like, "Hey, Mark, I'm a big fan. I've been following your stuff for a long time." And he said, I booked this trip to Consensus a while ago, and I bought the Whale Pass, which was like the biggest pass you can get for all the networking events and stuff like that, because I was coming here to network and I was going to launch these new things. But it's all over now. I can't do that. I'm like, well, what happened? What do you mean? He's like, well, I'm 50 years old and I've had this marketing business for the last few decades. And, don't worry if you're listening, I'm not going to call you out, but if I'm talking about you. But he said, I've been running this business for the last couple of decades, and we did really good, this marketing business. And I sold it. I sold the company. I had a big event. I got a lot of money, and I was kind of done. Like that area of life was done, and I was kind of like looking to the next thing. And I took all that money and I parked it into this stable coin because I thought it was stable. I thought it was like $1. And I didn't really pay attention to it because I thought it was safe. And I lost it all. Lost all his money. Now, there's thousands or hundreds of thousands of stories like that. I heard there was 14 or 15 suicides in the first week after that. But I don't want to dig back into that story again. The point is that lots of other cryptocurrency projects and even traditional Wall Street hedge funds were invested into that project, which means they have big losses. And then when they have big losses, that means someone else have big losses, and the dominoes are falling. Now, I warned about this 2 weeks ago, and I said that first, any stable coin that's not 100% backed with dollars or dollar equivalents is a problem. I think there's 3, USDC, GUSD, and Paxos. I said that's a big problem. And then I said that I also think that they'll start going after bigger and bigger ones, like Tether, for example, is probably going to be a big target. But it looks like the next one right now has been Celsius. So Celsius is a platform that allows you to earn yield on your Bitcoin and cryptocurrencies. So I could give them my Bitcoin, and they, in exchange for me giving it to them, they would pay me back 4%, 5%, 8%. I'm not exactly sure what their yield was towards the end here. I wasn't using it myself. Or we could earn yield that way. But the problem is, as I warned, is that it's very dangerous to earn yield that way because you're basically risking 100% to earn 4, 5, 6, 8%. That's a big problem. Now, a much better way to do that would be to keep the Bitcoin myself and earn yield a different way. One of the best ways I like to earn yield on Bitcoin or something like Bitcoin is through mining. And there's a lot going on. A lot of you may not be so happy hearing about Bitcoin and cryptocurrency right now. It's funny, I've been in this space for a long time. It's been since about 2015. I've been talking about it pretty publicly since 2016. Since 2018, I've been talking about it very publicly with my YouTube channel and so forth. And it never fails. People that I haven't heard from for years come out of the woodwork and start texting me and sending me messages when Bitcoin's at its all-time high. But when it drops down to where it's at now, nobody wants to talk about it, which is the opposite of how it should be. I'm sure you've heard the old saying about investing is that you're supposed to buy low and sell high, but it always seems to be the opposite. People want to buy high and sell low, and that's because of human nature. Our human nature gets us, right? We're greedy. And when everybody's making money, we want to make money. So it's the high. Everybody's happy. We want to jump in at the top. And then when we want to buy it at 65,000, and when it's at 20,000, nobody wants it. It should work the other way. But anyway, back to the collapse that happened. I want to talk you through this. So Celsius, big move. Like I said, it's a way that you would give them your Bitcoin, your cryptocurrency, and they would hold it for you. In exchange, they would give you 4, 6, 8%, whatever they were giving you. Also, they would give you loans against your Bitcoin and cryptocurrencies as well. And, we've always warned that there's such thing called counterparty risk, where if you give them your Bitcoin or cryptocurrency, there's a chance you don't get that back. Now, a rule of thumb, never, and I mean never, ever, ever loan money to somebody unless you can quantify the risk. Or, said a different way, how do you get your money back? What's the risk or the odds of you getting your money back? You want to know that. And so a lot of people gave Celsius their money. And unfortunately, this week they announced that they are pausing all withdrawals. Now, if you have money on that platform, this hurts you. And even if you don't have money on that platform, it might still hurt you. So let me walk you through what's going on. So the first thing, I'm going to walk you through what happened, but I'm just going to say right off the bat, it's not guaranteed that all your money's gone for good, but it doesn't look super good. All right. They've paused customer withdrawals so they could try to shore up their positions. If everybody's rushing to get their money off, it's going to cause a run on them and they will collapse. So they're trying to pause that until they can shore things up and maybe turn things around. They've brought somebody in to help them reorganize this. And maybe there's a chance you get your money back. Maybe there's a chance you get part of your money back. I don't know what the odds are on that. But like I said, even if you don't have money there, you are being affected by this. And you need to know why and how this worked so you can protect yourself next time. All right, so let's just run through this real quickly. And then I'm going to tell you about how the dominoes are stacking. So Celsius is going down now. There's 2 other potential bombs that keep getting bigger. And now today, maybe even a third one that's going to happen. So this is the second big one. There's 3 more bigger ones behind this. And so even if you don't have money on Celsius, you care because this is going to affect you. So let's just run you through this real quickly so you can understand how this works. So Celsius calls itself a network. Like I said, they were calling themselves like a lender. So you give them your Bitcoin, they lend you money back. Of course, they give you a fraction. So you give them $100, they give you back $25. Pretty good deal. But basically, their business model consists of taking these customer funds, these customer deposits, and then doing a whole bunch of risky stuff with it. And they have to do a whole bunch of risky stuff with it because they are promising to give you these crazy yields. Now, 4, 6, 8% returns don't sound that crazy, but in today's environment, when interest rates are at 0, it's pretty dang crazy. And what happens is, in order to get that kind of yield, they have to take on more and more risk. And so, in order for them to pay out that amount of money to compete with their competitors like BlockFi or Nexo or Crypto.com, they had to get more and more risky. And so they took the user funds and they deployed them across a whole bunch of DeFi protocols, decentralized finance protocols, and that's where things went wrong. Now, when the ultimate goal of your product is to maximize the yield, which they have to do to compete, then you should have a pretty solid risk framework. Now, the best investors in the world don't think about how much money they can make. They think about how much money they can lose. That's why Warren Buffett says the number 1 rule with investing is to not lose money. The number 2 rule with investing is don't forget rule number 1. And so if they're going to be doing this, they should be maximizing, or they should really be focusing on a risk framework. And then they would then give you that framework so that you could then determine what your risk is. As a matter of fact, when I was at the Bitcoin conference in April, I met with one of the heads of Celsius, and I told them that exact thing. And I said, look, I can't use your platform because there's no way for me to quantify that risk. And I said, if you really want to increase user adoption, you need to give us what the risk profile is, the risk management, so I can quantify it. Once I can quantify it, then I can determine, do I want to use it or not? And what are my risk management plans that I need to have in order to work with you? Okay, but they didn't. All right, now, what we see is that they were extremely risky. We saw last December, Celsius admitted losses related to the $120 million Badger DAO hack. Badger DAO, what the heck is that? Exactly. Exactly. Why were they invested into Badger DAO? Something that's extremely risky with customer funds. And they're doing that in order to try to generate that yield that they promised you. Now, the problem is that's extremely risky, and they're doing it with your money. So at that time, if people were surprised at that, going into something so young, so risky, then you probably have to put their entire risk management into question. Now, they told people that we were lending money out to people who were over-collateralized, 150% over-collateralized, but of course, we found out last December that wasn't the case. Then, like I said, with this Terra Luna fiasco, we found out that Celsius had massive exposure to that. Now, what we did find out, they told us, is that right before Terra Luna crashed, they pulled out at least $500 million out of Anchor. So now we know that they also had $500 million exposure. And that, again, another very risky protocol. Now, I don't know if their risk management was so good or if they were just extremely lucky, but somehow they got out of that with the skin of their teeth. But like I said, if anything, seeing what happened in December, seeing what happened here, we know that they have a very high risk tolerance. More risk tolerance than I would care to do with my money. So then why would I give them my money and let them do it with it? I pause so you can think about that for a second. If I wouldn't do it with my money, why would I give it to them so they could do it with my money? Now, most people didn't know about this, which then further begs the question, which is, if you didn't know they were doing this, why the heck were you giving your money to somebody that you weren't paying attention to, knowing they were doing this? Because this was public information. So anyway, it's clear that they have a high risk tolerance. Now, it's okay to take a lot of risk when everything's going up in a bull market. It's when things go down. Warren Buffett says that a rising tide rises all boats, but it's not until the tide goes out that we find out who's been swimming naked. And that's where we're at. So I want to finish breaking this down for you, and then I want to tell you about the 3 other bombs that are hiding that are potentially bigger and worse. I want to make sure you don't have exposure to that. And even if you don't have exposure, I want to make sure you're protected from that. And I'm going to be honest, I'm going to have a disclaimer. I'm getting caught up a little bit in it myself personally. Just before the break, talking about Celsius specifically, they locked withdrawals this week. There's a chance you might get some of your money out, but I wouldn't count on it. I wouldn't be holding your breath. But we'll see. Let's remain hopeful if you got money in there. But we're trying to learn from this. And what we can see is that Celsius was doing some very, very risky things. And if you had money there, you should have known about that. And if you didn't know about that, you weren't paying attention. And so, hey, look, don't get down on yourself. Don't let it happen again. All right. So let's keep going down this road. Basically, we saw they were doing these risky things. They barely got out of the Terra Luna by the skin of their teeth. But now they've also been putting their money into something, or their money. They've been putting their customer funds into something called staked ETH, or it's known as ST ETH. And it's another synthetic coin that's supposed to be pegged to the original ETH, which means, more risk. And it's also very illiquid, which means their money is locked up and they can't get their money out of it. Now, apparently Celsius holds another $500 million worth of this, and it's especially concerning because Ethereum is supposed to have this merge going on, and it just keeps getting delayed and delayed and delayed. And so depending on what happened with that, we could see this peg continue to break, potentially becoming unpegged like we saw with Terra Luna, which means Celsius could lose another $500 million. Celsius also had their own token called the Cell token, which also crashed. We saw it go from basically just become worthless overnight. And so once these things start going, they start going really fast. Everything works until it doesn't. That's what I always say. It works until it doesn't. And that's basically what we're looking at. All right. So what comes next? So Celsius had massive exposure to Luna. Who else had a massive exposure to Luna? And who has exposure to Celsius? Like I said, right off the bat, Celsius is causing the whole market to draw down because they're liquidating as much as they can, trying to post more collateral. And this is what happens in a liquidation event. No different than the stock market. When the stock market crashes, it continues to crash even faster because people are trying to cover their margins and their leverage on their stocks. This is why stocks fall really fast. And then you'll also see, when the stock market crashes, like say 2008, the stock market crashed, the S&P 500 dropped about 60%, and gold dropped 25%. Now, why would gold drop? Shouldn't gold be going up during that time? And the reason why is because of a liquidity event. When they start crashing, everybody's selling anything they can to get money to cover that leveraged position, which is exactly what happened back in the stock market, and that's exactly what's happening now. So it brings the whole thing down. So whether you only hold Bitcoin and it's in your cold storage, or whether you're playing with all these things, we're all being affected by this, which I'm not super happy on. Now, somebody might just say, well, shoot, shouldn't we pass some laws that prohibit this from happening? Shouldn't we pass a law that says, these Wall Street raiders aren't allowed to short the heck out of these things? Shouldn't we pass a law that prevents, whatever? And my answer is no. My answer is no. Now, I'm affected just like a lot of other people, but I would still say no. And the reason why is I believe in free markets. And if somebody wants to post a risky trade, then somebody has to take the other side of it. That's how a trade works. A trade doesn't happen unless there's two willing people involved. Otherwise, there's no trade. And so in a free market, both people believe they're getting the better end of the deal. Otherwise, there would be no deal. And so somebody's willing to take that risk for the potential reward, and this person's willing to pay a potential reward for that person taking the risk. Now, other people get involved and they start betting on those two players, and then they're taking risk, and everybody's taking risk. And in a free market, that's just what happens. It's up to everybody to be educated on their own. The bigger problem, though, is we're in an environment that allows this to happen in the first place, not because it's allowed legally or from a regulatory standpoint, because of the fake fiat monetary system that just pumped $8 trillion into the ecosystem over the last 24 months. And basically, in something called the Cantillon effect, go ahead and Google that if you want, and it says that the people that are closest to the money supply have the first advantage because they get the money first for the cheapest price, and then they start pushing it up as it goes down. So the hedge funds, the banks, they get the money first for basically free. You and I, we don't get any money, and we certainly don't get it for free if we do get it. And so they're getting billions of dollars for basically free, and then they're using that to manipulate markets, like, for example, buying up all the single-family homes in the United States. Now, they're paying 30% over asking price. You and I can't do that because we have to pay, well, now interest rates are 6%, but they got the money for free. So they can afford to pay more for the house because they're not paying for the money. And they're also using that money to take out these crypto positions and so forth. And so the problem is that we need to take away the money printer that prints all this money, that gives it to them, to then weaponize it against us. We don't need to pass laws to prohibit people doing stuff with their money. We need to pass a law, or not even pass a law, but just take away the ability to print this money and give it to everybody. All right. So what's the next bomb that's about to drop? Well, let's see. What do we got? We have... the STH, that's a big problem. Like I said, this is this new synthetic pegged version to Ethereum. And it's something that we can learn about illiquidity, right? Obviously, it involves Celsius. Like I said, they have about $500 million in there. And a lot of it is in this STH. All right. Now, Celsius is, like I said, caught with this because it's illiquid, and they've been paying down this debt, which has been helping. It's pretty good. But a lot of it is caught in that. And when that blows up, who else is holding that? And that's something that we have to figure out. And And it looks like that next player, that next one to drop, could be something called 3AC, if you've ever heard of that. Stands for Three Arrows Capital. Now, Three Arrows Capital wasn't really a crypto firm, as far as I know. I believe they were more of like an FX trading, which is like a foreign currency reserve trader. And they've been trading in that, and they figured, hey, we'll take our chances in the crypto market as well. And they have, and apparently done really well. Now, Warren Buffett famously said, I believe it was Warren Buffett, says that a rising tide rises all boats. But when the tide goes out, we see who's been swimming naked. And so that's exactly what's going on here. Rising tide, rising all boats. Now, since we've been in this long bull market with trillions of dollars sloshing around, everything's going up. Everybody looks like a genius. And Three Arrows Capital has done really, really, really well. The problem is with all these leveraged positions that allow them to grow really fast, when it works against you, the leverage also tears you down really fast. And that is part of the problem that we have. Now, Three Arrows Capital looks like they're going down. Now, it hasn't been a formal announcement, but per the chatter I see on the street, they have basically been ghosting everybody. They're not putting out any releases. Traders that they work with are reporting their credit lines being shut down, their funds being taken, and this is monumental. If they collapse, this will be monumental because they borrow from every single major lender. So the other ones I already mentioned, BlockFi, Nexo, Celsius, Genesis, etc. So as I said, right, I was supposed to give my money to BlockFi, Nexo, Celsius, and they were supposed to loan it back out again to traders who were over collateralized, traders like Three Arrows Capital. And so they've been borrowing from all these people. So if they're going down, if they're illiquid, then who has exposure? I want to tell you who has exposure. I want to tell you the dollar amounts, and you will be blown away. And then I'm going to come back, show you some perspective to maybe make this not look so bad. And I was talking about Three Arrows Capital. Now, Three Arrows Capital was borrowing money from a lot of people. Now, we don't know exactly. So some of this is speculation. I'm not trying to spread any FUD, but there's some things we do know for sure and some that we don't. So, for example, the last public number for Three Arrows Capital's assets was about $20 billion. Okay, so we do know that. Now, we don't know what their real NAV, net assets value. We don't know what that is. Rumors are that they might have been losing some, but we know the last time it was about 18 billion. So we know that. We know they were borrowing from most of these major lenders. We don't know exactly who. We don't know exact amounts, but the major lenders are Celsius, who we're talking about, Nexo, BlockFi, and Genesis, which is backs a lot of these as well. All right, so that's some of it. Now, if we look at this 18 billion, it's a big number. It's a real big number. And if they go down, then it continues to spread. So now, again, not trying to spread FUD on these companies. FUD means fear, uncertainty, and doubt. But if they've loaned money to Three Arrows Capital and they show that on their balance sheet, like, oh, we have $5 billion on our balance sheet, then their balance sheet looks strong, which allows them to back their leverage positions. They have collateral to back their positions. But if Three Arrows Capital goes down, that potentially, let's call it hypothetically $5 billion, is gone. And now all of a sudden, without that $5 billion, they don't have the backing to back the leverage that they have in the system. That's how this works. All right, so these lenders aren't prepared for this. And then the next one goes down, which then drags the next one down. Now, $20 billion, it's also rumored that a lot of Wall Street hedge funds also have money in this as well, which I wouldn't doubt. So then it starts spreading to Wall Street. Now, Wall Street at least has, the Fed that has their back. The Fed is the lender of last resort. They're there to make sure banks are backstopped, meaning don't go bankrupt, which we saw, in 2008, the too big to fail. But crypto has none of that. Crypto has none of that. It's going to go down, and no one's going to come to save it. Now, part of this is, it's part of the financial markets that we're going through. Like I said, we're shifting from this long-term bull market of prices going up, and now we're potentially shifting into a long-term secular bear market, meaning we could see prices going down for a long time. That's the way I'm leaning right now. I'm not trying to make a long-term prediction, but that's the way I'm leaning. But at the same time as we're seeing the financial markets rotate, we're also seeing the birth of a new technology and a new industry. There was an article that came out this week on Market Watch. It says, why is crypto crashing? Mark Cuban says that crypto is going through the lull that the internet went through. So Mark Cuban, Shark Tank, owner of the Mavericks, outspoken investor, etc. Of course, he got rich in the early days of the internet. He started an internet company, sold it off for whatever, a couple $1 billion. And so he knows about these market cycles. And he says it's like the lull in the internet. So think 2000. So from 1995, the first public company went public, and then it brought all the money in. And then the VCs pumped it up through IPOs from 95, 96, 97, 98, 99. By the year 2000, anything with a .com on its name was going for lots of money, like Mark Cuban made. Amazon pumped from $5 to $80. It was insane. But then the crash, the .com crash, 2000. Amazon went from 5 to 80 and all the way back down to 5. But it came back. That's the lull that he's talking about. It came back. And he thinks that cryptocurrency is in the same downtrend that internet and tech companies saw in the early 2000s. He said that crypto is going through the lull that the internet went through. And he compares it, which I think is a good bet. But I think if you look at that, you'll realize that in 2000, when that internet lull that he calls it happened, most of the .com companies never made it past that. As a matter of fact, most of the big internet companies today, Facebook, Twitter, Instagram, they didn't come around until the mid to late 2000s. And so if you were trying to pick the winners in the new internet age in 1999, 2000, they weren't around. Amazon made it, sure, but most of them didn't. AOL, Netscape, etc. They didn't make it. It was not until the late 2000s that we got the Facebooks and the Instagrams and the Twitters, etc. Okay, but I think he's right. But are you in the Netscapes? Are you in the Amazon? That is the question. Now, again, it's not just the internet age that was like that. As a matter of fact, anytime we have a new technology, it's the same thing. We can go back to 1817 in the city of Mannheim, Germany. There was a local inventor by the name of Carl von Drais, and he unveiled a brand new futuristic invention that no one had ever seen before. He just developed it. It was called a Laufmaschine, or a running machine in German. And I'm sorry if you speak German, I probably butchered that really bad. But it was basically what he invented was the world's first bicycle. There were no pedals, there was no seats, there was no chain to connect the wheels. The rider had to propel it with his feet and then balance on it with momentum, sort of like a scooter, right? It was super crude, as you could imagine, but it worked. But the reaction was instantly divisive, right? Some people thought it was significant. Oh my gosh, look how nice this is. Now we can glide around, right? But then several governments, including the United Kingdom, the U.S., and even Germany, banned its use for posing too much risk to pedestrians. Sound familiar? Nevertheless, the development of the bicycle persisted over the next several decades, and public interest grew. By the 1880s, cycling had become incredibly popular. Even the Queen of England owned a bicycle, making it fashionable among Britain's elite. So you see, anytime there's a new technology, it goes through these cycles, and people want to poo-poo it and shut it down. But you can't stop a good idea whose time has come. Now, the rapidly growing popularity of bicycles prompted inventors and engineers across Europe to work feverishly on new designs, safer designs, innovations. There was so much brainpower devoted to cycling that by 1896, a full 15% of British patents were issued for bicycle designs. The industry exploded. Bicycle factories, tire factories, repair shops, sales everywhere. You get the point? Sort of like the internet boom, sort of like the crypto boom. Bicycle mania was in full swing. So naturally, it didn't take long for the bankers. Now, once the bankers got involved, then it went bonkers. 70 bicycle-related companies went public on stock exchanges in the United Kingdom. In 1896, the number swelled to 363. And just in the first 6 months of 1897, another 238 were listed. Sort of like the dot-com boom, sort of like the crypto boom. Now, most of these companies were nothing. They're hollow. There was no management. There was no hope of them ever making a profit. They just went to the market and said, I'm a cryptocurrency company. No, they said, I'm a bicycle business, for real. That's what they said. And their price is stored. Just like in the .com boom, if they put .com on there. The bikes were so popular, rose so quickly, the Financial Times devoted a section of its daily newspaper to the industry, a cycling magazine. And it kept growing. By 1900, roughly half of the bicycle companies that had gone public were no longer in business. Why? The index fell 70% from its peak. Well, why? Because there was no market. It got too exuberant. Now, did the bicycle die? No, not at all. As a matter of fact, mountain bikes and road bikes now routinely sell for over $10,000. Biking's huge. Mountain biking, it's all huge, but it got too feverish, just like the .com boom, just like the cryptocurrency boom. This is the way new technologies work. The automobiles were no different. The same thing happened. And that's where we're at with cryptocurrencies today, sort of like the lull the internet went through, sort of like the lull the cars went through, sort of like the lull that bicycles went through. But it doesn't mean it's over. However, most of them won't make it. Bitcoin will. Bitcoin will. Buy it, put it in your cold storage, forget about it for 3 to 5 years, forget about everything else, get rid of that stress in your life, and you're going to be okay. Because the future is decentralized. You're listening to The Mark Moss Show, talking about the decentralized revolution, Bitcoin, cryptocurrencies, and more. That's what I got for you. Hopefully you enjoyed that. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.